We're moving into Chapter 3, and in Chapter 3, we talk about tax planning strategies and the limitations that are related to that. And so, as I mentioned before, sometimes you hear people say the goal of tax planning is to minimize taxes. That's not true. And so online students have a discussion board where they will defend that. And then those of you in the hybrid class will talk about that probably in the classroom. But just keep in mind with tax planning, there are lots of strategies. There's a difference between tax planning and tax evasion. We want to make sure that everything we're doing in our tax planning obviously is legal. However, tax laws can change and did change in 2018 drastically and caused a lot of issues with tax planning that had been done previously. And so a lot of what we do in this chapter is pretty straightforward planning. And I'm going to look at problem number 40 from chapter 3. And this one has to do with timing. And so we've got Manny. He's a calendar year taxpayer. That's important to know, meaning his tax year ends on 12/31. He uses the cash method of accounting, and it's a sole proprietorship. In late December, he performed $20,000 of legal services for a client. And so services were performed in late December, okay? Just writing down the facts at this point. So typically, he has his clients pay upon receipt. But Manny is sitting at a marginal tax rate of 37% this year and next year. And he can earn an after-tax rate of return of 12% on his investments. So the question is, should Manny send his client the bill? Remember, he's cash basis. And so he's in a 37% marginal tax bracket. And he has a 12% return on his investments. And so if he sends the bill in December, he's going to get the money in December. And so they don't give us a year, but just so we kind of understand, let's just say this was December 2018. If he sends the bill, then he's going to report this on his 2018 income because he's going to get the money immediately. If he sends it in January of 2019, then it's going to be in his 2019 income. Now keep in mind, he pays tax on that at the end of the year. And so 1 month can make a 1 year difference in timing. And so what we want to look at is, what is he better off doing? Is he better off paying the tax now or paying the tax later? That's what we're looking at. And so option 1 is send the bill in December, assuming he will get payment in December. And so he's got $20,000 of taxable income. And he is sitting in a 37% tax bracket. And so that's $7,000, do the equal sign, $7,400 in tax. And that is the present value, because that's today. And then if you want, from there, you look at the after-tax income, and the after-tax income is the $20,000 minus the $7,400, or $12,600. That's his after-tax income for option 1. Option 2 is to send the bill in January. So if he does that, he still has the $20,000 taxable income. He's still in the same tax bracket. This is where tax planning can come in. Tax brackets can change. They don't very often, but they can. Okay, so he's got a $7,400 tax that he will pay in 1 year. Okay, so what we have to do with that is get the present value. He's going to pay it in a year. So we take that $7,400, and you can use your financial calculator, you can use Excel, whatever you want to do, but I'm going to use the discount factor. And that factor can be found in a table. You can Google that online and find it in your book. So, but the discount factor, what that tells me is that if I took $6,608 and I invested it at 12%, because this factor, I probably should have put this on here. This factor is based on an interest rate of 12%. Okay. if I took $6,608 and I invested it at 12% in 1 year, I would have $7,400. Okay, that's all that means. The present value, what it's worth today, is $6,608. So from that, we take our after-tax income, which is $20,000. We're at 12. $20,000 minus 6,608, because that's the present value, and that gives us $13,392. So sending the bill in January, option 2, gives us an after-tax income of $13,392, which is what we want to do. Now, why is that? It's because you can take that $7,400 that you would have to pay at the beginning of 2019, and you can invest it at 12%, pay the tax at the beginning of 2020, and make a little bit of money. And that's why that's a clear winner. So option 2 is the winner. Okay, so another one I want to look at in chapter 3, and I always try to do something similar to your homework. As I've told you, I'm not going to do your homework for you, but I try to help you out a little bit. And if you've had Intermediate 1, or if you've had business finance, you know, we do a lot of present value calculations in this chapter, and so that should be very familiar to you. If you have not had either one of those classes, then you might want to go find a YouTube video, go to accountingcoach.com, or just Google calculating present value and watch some video lectures on that, or read up on that a little bit. And again, I'll try to help you as we go through these. But I'm going to look at problem number 49. So Jonah has the choice of paying Rita $10,000 today. So today we're going to pay $10,000. Or $40,000 in 10 years. Sometimes when you look at these, you think, well, that's kind of obvious, isn't it? But we have to calculate it to see. So we have a 12% return. So in other words, he could wait 10 years, pay $40,000, or today he could pay 10. So what we need to find in order to know if this is a good decision either way is we need to find the present value of these two numbers. So the present value, because you've got to compare apples to apples, the present value of $10,000 today is $10,000. That's pretty straightforward. So we have to find the present value of $40,000 in 10 years. And so N is 10, I is 12. And N is the number of periods, not the number of years. So you have to be careful and watch how often your interest accumulates. And so we want to find the discount factor for that. And the discount factor for that is 0.322. Or again, you can use your financial calculator, whatever you want to do. I don't care. So if we take that $40,000 and we multiply it by 0.322, we're going to come up with $12,880. And so which one of these do we want to do? Do we want to pay $10,000 today, or we want to pay $40,000 in 10 years? So we compare apples to apples. Now, there's some risk. I mean, we're assuming we can continue to get this 12% return. But based on what we know, it would be better to go ahead and pay the $10,000 today. And so, again, it's just understanding present value. What that means is if I took $12,880 today and I put it in a bank account for 10 years and I earned 12%, I would have $40,000 at the end of 10 years. And that's basically the way you have to analyze that. The other one that I want to talk a little bit about, if I can find a good one, is shifting. And so this is about timing. And so you can also talk about shifting income. And one of your homework problems talks about shifting income. It's problem number 51 in the textbook. I don't know exactly what it is in your homework. But this is Tawana, and she's paying her son's college expenses. And he also works as a pizza delivery person. and she has a sole proprietorship. So it says, what can Tawana do? And so as you work through this one, be thinking about shifting to someone in this problem who's in a lower tax bracket. And then it asks us, how much pre-tax income does it currently take Tawana to generate $8,000 after tax? So you're going to use a little bit of algebra there, pretty easy. You should be able to figure that one out. And then it said, if Jonathan worked for his mother's sole proprietorship, what salary would she have to pay him? And so keep in mind, in this problem, you're only using what's given. Don't overthink this. And so, again, use a little bit of algebra. And keep in mind that Jonathan pays 15% in taxes. And then finally it said, how much money would the strategy in Part C save her? So in that, you're going to take the information from B and the information from C, and you're going to analyze that to determine how much she would save. And so it's a really good, very applicable, real-life problem that we work in this homework. And again, as I've told you before, I won't do your homework for you, but I'll often give you hints in these videos, or I'll work problems that are very similar. We have another problem in your homework where we have two different stocks, and again, we're looking at shifting, and so we want to look at tax savings and determine what's better. And you always want to think about the savings on a loss. If I have a loss, so let me see if I can explain this. If I make $100,000 a year and I'm sitting in a 25, and I'm going to make this real simple. This is, as you know, there's marginal graduated tax and incremental tax and all that, but just make it real simple. If I'm paying 25% in taxes, then I'm going to pay $25,000 in tax, okay? However, if I make $100,000 and I have a $10,000 loss, okay, that means I'm going to pay tax on $90,000. And so my tax is going to be $90,000 times 25%, or $2,250. So I paid less in tax because of this loss. How much less did I pay? Well, $25,000 minus $22,500 is $2,500. And so I paid $2,500 less in tax because of that loss. So another way to look at this is, if I have a loss of $10,000 and I'm sitting at a 25% tax bracket, then I have a tax savings of $2,500. So a loss is not good, obviously, but there is a benefit to a loss. And so we talk about the tax benefit of a loss, and that's what this is. Okay, so hopefully that helps you work through those homework problems. I think that's it. Again, it's a great chapter to begin thinking about tax planning, and if that's something that you want to consider looking into, or even just tax planning for yourself, I think it's a great chapter to learn about that. So let me know if you have questions. Thank you.